As the markets continue to reach record highs, you may constantly ask yourself whether it's worth jumping into an investment or waiting for the right moment. Now, the data I'm going to use for this video is coming from the Charles Schwab Center for Financial Research, where they highlight there is a high cost to waiting for the best entry point. And before I dive deeper into things, understand that when it comes to investing, it has been proven through numerous studies that our mindsets tend to have greed with the urge to buy stocks when they're doing well, to then having fear with the urge to sell stocks when they are doing bad, many times leading into a repeating cycle of never seeing true growth. Knowing that, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's now go over the 5 main approaches to investing and how they impact your wallet. Now, Schwab's research team ran a 20-year study from 2005 to 2024, comparing 5 different investors where they each earned $2,000 at the start of every year, but they all chose to invest differently. The first scenario was Peter Perfect, who was a perfect market timer. He was very fortunate and waited and invested on the lowest market day of every year into the S&P 500, which, if you didn't know, is considered the benchmark for the US stock market. And every year, his perfect timing came out to be on the days like April 4th of 2005, then June 13th of 2006, and he was able to do this for 20 years straight, giving him a perfect track record that is unheard of. At that rate, he may as well just go buy a lottery ticket. But after that, we then have Ashley Action, who took a simple approach and said each year, once she received her cash, she would invest her $2,000 into the market on the first trading day of the year. No matter what, she's investing immediately. Then we have Matthew Monthly, who divided his $2,000 into 12 equal portions, creating what's called dollar cost averaging. Now, dollar cost averaging pretty much means that you set up automatic investments on a particular frequency, typically weekly, bi-weekly, or monthly. And a lot of you may already be doing this without realizing it for things like a 401k or other types of plans that you may have set up. But after that, for Matthew, we then have Rosie Rodden, who had incredibly poor timing on perhaps terrible luck, where unlike Peter Perfect at the lowest market prices of the year, Rosie invested at the market's peak every year. And lastly is Larry Linger, who left all of his money in cash investments like T-bills every year and never took the risk of investing into stocks. Now, keep in mind that all of the investors invested into the S&P 500 index, and for Larry, they used the 30-day Treasury bill index with their averages. And the results after 20 years came out to show that Peter Perfect, with perfect market timing every year, led to the highest returns. But the surprising part here is that the perfect timing didn't necessarily impact the returns as much as you may think, where Ashley Action came in second, about $15,000 less, but she simply invested right away and didn't even think twice. After that was Matthew, who invested every month, and he was also very close to Ashley in regards to the end results. Following that was Rosie with the worst timing, that was another $15,000 less. Then Larry, who did not invest in stocks, was significantly lower. Knowing this, let's now go over what the data proves about market timing. For starters, understand that in a typical 12-month period, it's reported that the market has risen 75.6% of the time. So whether you are one like Rosie with terrible timing on your investments, to dollar cost averaging, investing yearly, or you are perfectly timing the market every year, which is pretty much unheard of. The key thing though to understand is that as long as you are investing and gaining exposure to the market over time, then your investments are likely to grow. A fun fact for you is that for an investment like the S&P 500, it has shown historically that since 1957, it has averaged just over 10% per year, which would have actually turned $1,000 into nearly $1 million today. Charles Schwab also reports that they actually analyzed 80 rolling 20-year periods dating back to 1926, and for 70 of the 80 periods, the rankings were the exact same for winners in the order of Peter Perfect, Ashley, Matthew, Rosie, and then Larry. Not just that, but the 10 periods when the results were not as expected, investing immediately never came in last. Knowing this, another important data point to understand here is the impact on your future value if you were to miss just a few of the best performing days in the market. For instance, looking at the S&P 500 from 1995 to 2024, if you invested $10,000 in 1995 and never touched the investment, you would now have $224,000. But if you played around with the investments, say you had to sell some during a bad market because you needed cash, in the end, if you missed the 10 best days in the market, your portfolio would decline by over half, dropping your end value down to $102,000. To repeat that, understand that 10 days in the market, if you were to miss out and they were the best 10 days, over a 30-year period, your portfolio's end results would be cut by over half. Now, if we look at 20 of the best performing days that you missed, that means a total 73% less would be resulted to giving you only $60,000. And if that were 30 days, end portfolio down to $38,000. And if you think about it, over a 30-year time period, missing 10 to 20 days, it really doesn't sound like much. And so the real note to emphasize here on why you definitely don't want to play around with your investments is the fact that many of the market's best days happen in bad markets. You see, out of 50 of the best market days, 50% of them happen during a bear market. A bear market typically refers to a period of time when stock prices are falling, investors start to believe negatively, and selling becomes more common. So for many, a bad market can cause fear, and like I said at the very beginning of the video, that could lead you into the urge of wanting to sell investments. Not just that, but if you don't properly save and have something like an emergency fund in place, a bear market may even force you to have to sell your investments, which thereafter would cause you to miss some of those best performing days in the market that impact your future returns significantly. By the way, if you want to place the store short-term cash for things like an emergency fund or saving for a house, I'll have direct links below to some of the top options for high yield savings accounts or CDs that are available in the market. But after that, realize that 28% of the best days in the market occurred during the first 2 months of a bear market, and also realize that that is a time period where some may be recovering their finances and not have the opportunity to yet invest and get that exposure, where the last 22% happen during the rest of a bull market. Now, please note that if you are investing heavily into individual stocks rather than index funds, that after analyzing different times in the market going all the way back to 1927, over the typical 20-year period, only 21% of individual stocks survive and outperform the market, where 52% alone are delisted. But knowing all this data, in the end, the decision on when to invest in the market, the majority of the time, if you are investing for the long term into broad index funds like the S&P 500, then investing your money as soon as possible can immediately give you exposure to the market that has been proven to be among the best approach. And do realize that for this scenario, the worst approach is to actually have your money out of the market in cash or in low returning investments, which is why Larry came out on bottom for nearly every study. So to sum this up, the key takeaways are: don't try to time the market, because based off the data, it's typically not worth it unless you are a lottery winner or you do it perfectly every year. But also realize to start investing as soon as possible, because if you have the funds to invest for the long term, time out of the market and missing the best days can greatly cost you. Now, let's say you are one that is nervous to get started because you've never invested on your own. I would highly recommend to consider dollar cost averaging on a consistent basis, because as time goes on, you may be surprised where things can end up over time. Long term, if you pick the right investments like a broad US stock market index fund, then it's almost always better to invest, even if you have bad market timing, because in the end, you are at least invested, and the market over long periods of time shows that it appreciates in value. Now, if you want to start investing on a new platform or check out some of the top high yield savings accounts or CDs, I'll also have a direct link below to some of the top options currently available in the market. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. And as always, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.